Welcome to episode 2 of The Spotlight. We've got some interesting developments to cover today, ranging from the oil rally and the current dynamics in the bond market, to yacht-backed securities and the slowdown in consumer credit. Let's jump right into it. OPEC is sticking to the game plan and agreed to increase production by a nominal 400,000 barrels per day for March, but it's struggling to meet these ceiling levels, and that will only compound the supply-demand problem, given that the US oil production capacity has yet to hit pre-pandemic figures. The 19 OPEC Plus countries with quotas underperformed their production targets by a combined 832,000 barrels per day in December, according to the group's technical committee. If this trend persists, we could see deficits start to build up and put upwards pressure on oil prices, which would be problematic in the face of current inflation levels. This points to an increasing need for Iranian crude to help temper the tight oil market and cater to increasing demand, and the consensus view at the moment is that it's likely to come back online in the second half of this year. We've also seen continued global inventory draws, with total oil inventory down 6.4 million barrels week over week, well below the 5-year range. We're also seeing ongoing and escalating geopolitical tensions with Russia and Ukraine, which has the potential to disrupt oil market supply. We're also seeing various supply dislocations in Libya, Ecuador, and Nigeria, and future events affecting oil supply should continue to be monitored. Lastly, the dollar has also retraced back into its prior trend line, down 1.8% week over week, which has provided a small tailwind as well. We're seeing pretty hawkish developments coming out of Europe. The Bank of England raised rates by 25 basis points, and 4 out of the 9 members of the Monetary Policy Committee had voted for a 50 basis point hike instead. At the ECB press conference a few days ago, Lagarde said that they would most likely stop QE and taper much faster than the market expected. This raises the chance of EU hikes this year to follow in the hawkish path of the Fed. We're also seeing the market reprice this hawkish shift in messaging. The 1-year Euro swap rate has exploded by 50 basis points in a 6 sigma move last week, and we haven't seen it in this territory since 2013. Yields are continuing to rise in the US as well, and we're also seeing credit spreads widen, notably in low grade and junk. Fed funds futures are now pricing in 5 hikes with a 30% chance of a 6th by end of the year, and they're pricing in the terminal rate of this cycle to be 1.9% in 2024, which then the market predicts the Fed has to start cutting rates again. A 1.9% terminal rate market expectation is significantly below the Fed's terminal target rate of 2.5% and signals that the market thinks this will be a quick and rather shallow rate cycle. This means that the market is more vulnerable to high rates due to the elevated debt levels and the general erosion of productive capital. Now we're seeing rising real interest rates as nominal yields surge and inflation expectations fall slightly. Credit spreads are also starting to widen, indicating that aggregate refinancing costs for companies are on the rise, and that has a carry-on effect on the pricing of risk premia, especially when real wages aren't going up to help service those increased real costs of capital. In the US, real wages peaked in mid-2021 and have been on a downward trend since. Continue to keep an eye on the yield curve. The 2s10 spread is hanging around the lows, and if it breaks down, we may start to see some preemptive stress as people potentially shift allocation in reaction to the curve as we move closer to inversion. After a rough year of repeated scandal, Credit Suisse has been trying to rebrand itself by creating a positive impression among principals and executives by financing their luxury assets such as private jets and yachts. CS has packaged up a portfolio comprised of $80 million worth of yacht and jet loans, and had to offer over 11% interest rate to entice institutions into the transaction. This also showed that the bank was willing to pay a high price to improve its capital position without relying on the equity markets. In 2017 and 2018, CS saw 12 defaults on yacht and aircraft loans, and also experienced increase in defaults on mortgage loans, and some clients were not particularly pleased with the bank. It may now be looking to give off the impression that it's reining in some of that risk to help repair its reputation. What other motivations would CS have to do this? Well, the larger loan portfolio that the yacht loans were pulled from also include loans against wealthy clients' holdings of stocks and bonds, and the bank was sometimes willing to offer 80% leverage on their positions, which the company acknowledged was above standard. With financial conditions tightening and awareness that most of their client portfolios are way over leveraged, it's likely that the bank wants to offload some of this risk in case default rates rise from tighter conditions as wealthy clients see vast amounts of their paper wealth disappear from both market losses and the broader economic slowdown. The last consumer credit print in November saw consumer credit soar by a record $40 billion versus estimates of $20 billion, as stimulus and pandemic-fueled savings started to disappear and consumers started to go back to accessing credit. Well, the Fed recently released the latest consumer credit report for the month of December, which saw a dramatic drop in the growth rate, with total credit rising just $18.9 billion, well below the consensus estimate of $25 billion, and a 50% drop month over month from November's $38.8 billion print. The section that stood out most in the report was the collapse in credit card growth, which after surging at a record monthly pace of $19.3 billion in November, collapsed to just $2.1 billion, the lowest monthly increase since the negative print in April of 2021. One possibility is that consumers have ran through their excess savings and now find themselves having to pay down a rather large bill from the holiday season, adding pressure to a slowdown in consumer spending as we move through 2022, which also puts pressure on broader economic growth in our consumption-driven economy. Another drop in growth in the next print would bring more evidence to refine this thesis. That wraps up this episode of The Spotlight. What developments do you have your eye on? Let me know in the comments below, and let me know what type of content you guys would like to see next.